Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, trade negotiations between the European Union and the United States made little headway this week, as Washington signaled that the bulk of tariffs imposed by the Trump administration on EU goods are likely to remain in place. Talks held in Washington on Monday saw EU Trade Chief Maros Sefcovic meet with U.S. Commerce Secretary Howard Lutnick and Trade Representative Jameson Greer, but according to several media outlets, including UK-based Reuters and US-based Politico, left European officials with little clarity on the US's longer-term objectives. According to people familiar with the discussions, speaking to US-based Bloomberg, US officials indicated that the 20% reciprocal tariffs, recently lowered to 10% for a 90-day period, would not be removed entirely. Other sector-specific duties, including those on metals and vehicles, are also expected to stay. These measures are part of President Donald Trump's broader strategy to restructure global trade relationships, incentivize domestic manufacturing, and help fund a tax cut extension. In total, the EU faces tariffs on approximately 380 billion euros, $431 billion US dollars, worth of exports to the US. The EU last week delayed implementation of retaliatory tariffs targeting around 21 billion euros of US goods. That delay, also lasting 90 days, was intended to create space for negotiations, but the lack of substantive progress has raised concerns in Brussels, which is already preparing additional countermeasures should talks fail. Despite EU offers to eliminate tariffs on all industrial goods, including cars, the US has so far rejected the proposal. Washington instead appears focused on broader structural issues, including regulatory standards and strategic supply chain realignments. US officials reportedly floated the idea of European chemical firms producing more pharmaceutical precursors on American soil. As we discuss on my other channel, China Update, in a special release today, it seems also that the US strategy is to persuade trade partners to exclude China from these new trade blocs, bringing trade front and center in the US's wider geopolitical strategy as it seeks to compete in this new Cold War. The US president has long accused the EU of exploiting trade with the US, citing its goods surplus and comparatively lower tariff rates. In 2023, the EU's average trade-weighted tariff stood at 2.7% according to WTO data, though proponents of the president's strategy point to non-tariff barriers. The US imported over $52.3 billion US dollars in new vehicles from the EU last year, 5 times what it exported, most of which were German brand SUVs made in the US. While the EU has floated increased purchases of US liquefied natural gas as a potential concession, the Trump administration has shown limited interest. Energy purchases, however, remain on the table, with Trump recently stating that such deals could help close the trade deficit. Talks will now continue at a technical level, but officials on both sides remain far apart on key issues, including standards for digital services, artificial intelligence, and food safety, areas where Washington sees European regulations as non-tariff trade barriers. If you want to be on top of the most up-to-date news and analysis on global financial and economic markets, don't forget to subscribe, and you will be. And if you're enjoying today's episode, it's also a big help if you can hit that like button. It's 2 clicks of the mouse, but it's a tremendous help for a small, independent YouTube channel like this one. Thank you so much. Next up, we move to Asia. UK-based The Financial Times, in a piece this week, tells the story of Anurag, a former travel agent from Mumbai's middle-class suburb. A, quote, silent casualty of India's expanding debt trap, end quote. After losing his job late last year, he accumulated over $13,000 US dollars in personal debt, pushing his family into emotional turmoil. The harassment from creditors took a darker turn when the agent contacted his wife's employer, causing public shame and psychological distress. The story, while deeply personal, the outlet writes, is increasingly common, and indeed is becoming a structural problem behind India's otherwise positive growth story. Once seen as the engine of India's economic rise, the country's urban middle class is now faltering under mounting household debt. Many have turned to credit to maintain the illusion of prosperity amid stagnant incomes and surging living costs. India's retail lending grew more than 30% in 2023, much of it unsecured, financing everything from basic expenses to aspirational purchases like cars, electronics, and private school education. According to the Reserve Bank of India, RBI, household debt has risen from 35% of GDP in 2020 to 43% in 2023, with the RBI raising capital requirements on personal loans to curb excessive borrowing. Credit lines have tightened, especially for high-risk borrowers. As a result, defaults are rising, with late payments on personal loans over 90 days hitting 5.2% by late 2023, up from 2% in 2019. This is a significant rise. The broader economic implications are severe. India's GDP growth has cooled to 6.5%, down from 9.2% the previous year. Consumption, a key driver of growth, is slipping as a growing segment of India's population grapples with insolvency. Research by Marcellus Investment Managers suggests up to 10% of middle-income Indians are caught in a debt trap, while household savings have plummeted to a 50-year low. The surge in unsecured lending via credit cards, fintech apps, and microfinance has reshaped traditional attitudes towards borrowing. Aided by technology, even lower-income families accessed credit with unprecedented ease, but this rapid financial inclusion came without equivalent education or safeguards. Many now find themselves over-leveraged and under pressure from aggressive debt collectors, often facing public humiliation. The crisis has become political. Karnataka state pressed laws to curb coercive loan recovery practices after a wave of rural suicides. Yet at the national level, critics argue the Modi government has been slow to acknowledge the depth of the problem. Financial watchdogs have begun to act. The RBI in late 2024 imposed penalties on predatory microfinance lenders and rolled back some restrictive measures in early 2025. Still, with over 13% of microfinance loans delinquent and gold pawning up 77% year on year, household stress remains acute. Unless policymakers intervene meaningfully, India's much-touted middle-class boom risks becoming a trap, not a launch pad for national progress, but a glaring fault line beneath its economic miracle. And finally for today, we return to the tariff war. Canadian Prime Minister Mark Carney has announced a conditional exemption from retaliatory tariffs for automakers importing US manufactured vehicles, provided they maintain production and investment in Canada. The move aims to shield domestic manufacturing while offering relief to companies like General Motors, which operate plants in Ontario but import large volumes from the US. Carney introduced tariffs of up to 25% last week in response to similar levies imposed by US President Donald Trump. The automotive industry across Canada, the US, and Mexico has long been interwoven, and the tit-for-tat duties have sparked fears of production shifts away from Canada. Quote, "Our counter-tariffs won't apply if they continue to produce, continue to employ, continue to invest in Canada," Carney said. If a manufacturer reduces local output, its ability to import tariff-free vehicles will be scaled back, according to the Finance Department. Already, Stellantis has idled its Windsor plant, and General Motors is suspending operations at a Canadian facility due to soft demand for electric vans. Meanwhile, Honda is reportedly considering moving production to the US, but said its Ontario plant will continue to operate at full capacity. Industry Minister Anita Anand confirmed Honda has not made any decisions to shift operations. Carney, who is campaigning ahead of the April 28th election, criticized Trump's tariffs as counterproductive and pledged a $2 billion Canadian fund to support Canada's auto supply chains. The head of the opposition also promises tariff negotiations with a tax cut on Canadian-made vehicles. To ease broader economic pressures, Ottawa has announced a 6-month tariff reprieve on select US imports essential to manufacturing, healthcare, and public safety. The move offers temporary relief for the $60 billion Canadian in counter-tariffs Canada has imposed beyond the automotive sector. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Wednesday, and I will see you for another set of updates tomorrow.